Corporate finance, accounts payable or trade credit. Achieve financial fineness using corporate finance. Accounts payable or trade credit. When we're thinking about short-term financing of a business, we often basically overlook the accounts payable and go right to other types of financing options. But obviously the accounts payable is going to be important because it's typically a large portion of the short-term financing and something that's going to be involved in many types of transactions. We can kind of compare and contrast it to our strategy that we talked about earlier on the receivable side and kind of think about our management of the cash strategy as it goes along with it as well. When we talked about the accounts receivable, in other words, of course, we have an incentive then to get paid sooner so that we get the cash sooner, and that increases our cash flow. When we think about the accounts payable, if we're thinking about increasing our cash flows to finance our operations, then typically we have an incentive to have the accounts payable last longer, not to pay them off as soon as we can, so that we can increase our cash flow if we're not going to get penalized. So we typically would say, okay, on the accounts payable side, is there a way for us to increase the accounts payable without it causing us any other type of problems, which could then help with the financing of the company, help with basically the cash flow. So the accounts payable can also be called trade credit, accounts payable for a large portion of the short-term financing. So for many types of companies, the short-term financing of the company is often through the accounts payable. It can be then, of course, significant. It generally grows as a business grows in size. So if you're a small business, then it's likely that you don't have as much on the accounts payable. Many times, many smaller business, and this will depend on the type of industry that the business will be in, but when they start to grow, they might then start growing on the accounts receivable side, developing a larger and larger accounts receivable department to manage the collection process, and then it might take a little bit longer possibly to manage the payable side, or for it to grow as well to the same type of extent that you're now managing, of course, the accounts payable in a similar type of way. So obviously as the business grows, then you're going to need more specialization in those types of tasks as they get more specialized, and that will change from and be different in industry to industry as well. So accounts payable payment method, usually 30 to 60 days. So when we're talking about accounts payable, it's kind of the inverse as the accounts receivable we talked about before. When we have a receivable, typically if we make a sale on account, we expect to be paid in 30 to 60 days or something like that. If we have a payable, meaning we are now the purchaser from a vendor, then we'll typically have the same kind of issue on the other side of the transaction, the 30 to 60 day time period. So long payment period could frustrate suppliers and reduce rating from credit bureaus. Our normal incentives, as we talked about, would be, I would like to increase the accounts payable time period in which we will pay, because that would mean that we would have more of the financing, we would hold on to the money longer, and if there's no penalties for that, that's basically what we would like to do. But of course, on the receivable side of things, the people we're dealing with, they have the opposite incentive. They want to get paid sooner, and if we try to pressure our vendors to having very long payment periods, we're going to pay them for a long period of time and have our payables outstanding for a long period of time, that will frustrate or anger most likely, the vendors that we'll be dealing with, and it also could have a negative impact on the credit bureaus. So cash discount will impact the decision process, just like we discussed on the receivable side of things. On the receivable side of things, we discussed about the idea of, if I want to get the money sooner, maybe I offer a cash discount, doing a pros and cons, weighing out the cost of the discount versus the added cash flow that we would get from providing the discount. We do and will work practice problems related to a discount and that decision-making process. On the payment side of things, we have the same kind of issue. We might be offered a cash discount, and our question then would be, well, we would like to hold on. Our general policy is to pay as late as possible because that would maximize our cash management strategy and finance the business as much as possible. But obviously, if we get a discount for paying sooner, then that might be a better incentive for us to do that as well. So clearly the incentive of the discount, even though often small, if we're talking about just a cash discount, will be enough for us to change our policy and then be paying off sooner in order to take advantage of the discount. But we have a similar pros and cons type of analysis we need to consider for that. Cash discount might look something like this. So a deduction in price if paid in a shorter time frame. So the term on the discount could look something like this: 1/10, net 60. That basically means that we provide you a 1% discount if you pay within 10 days, and if not, we expect to be paid in the normal, in this case, 60 days. Or in other words, if there were no discount, in this case, we would have it just say net 60. We expect to be paid in 60 days. If that were the normal time frame, then we as the payer would wait till that very last day of the 60 days so that we can hold on to our money as long as possible, maximizing our cash management strategy, and then pay on day 60. If we're managing our accounts payable, that's basically what we would, kind of strategize to do. But if they give us a discount, if we pay within 10 days, then we got to say, well, is it worth my while to pay earlier or to hold on to the money? If I pay earlier, then of course I get that small, but could be significant discount in order to change my policy. So then of course we have to question, should we take the discount or should we just wait out for the full 60 days in this case? So this would again be a 1% discount if paid in 10 days. Otherwise, you got to pay in 60 days. The cost of not taking the cash discount can be calculated like something like this formula. The discount percent over 100% minus the discount percent times 360, basically days in a year if you're assuming even months, 30-day months, 30 times 12, divided by the final due date minus the discount period. I believe we will have example problems related to this in our Excel problems as well as our problems in OneNote type problems. So net credit position. What is a net credit position? That's the difference between the accounts receivable and the accounts payable. So when we're thinking about the receivables, those are things that we are selling on account. We then have receivables on the books for money that people owe us. When we're thinking about the payables, those are things that we are purchasing on account. We then have a payable on the book for things that we owe the vendors. And if we subtract those two out, that's going to be our net credit position. Calculation is positive if the receivables are larger than the payables. So if we say receivables minus payables, the receivables are greater than the payables, then we have a positive outcome there. Larger companies often have higher receivables, while smaller companies often have higher payables. That's a general trend. It'll differ from industry to industry and company to company, but typically the larger companies might then end up with the larger receivables on the books, and the smaller companies might then end up with the higher payables basically on the books when you're looking at this calculation of the net credit position.